So, Neogen stock. Man, it's been in a total freefall, right? But something just happened. Their latest earnings report dropped, and suddenly, everyone's paying attention. So the big question we've got to tackle today is this. Is this the start of a real turnaround, or is it just a flash in the pan?
All right, first things first, let's just look at the market's verdict. I mean, a 16.5% pop in a single day? Wow, that's not just random noise, you know? That's a huge signal. The market is screaming that something has fundamentally changed here. So our job? Let's dig in and figure out exactly what that is.
Okay, so here's the game plan for how we're going to break this all down. First, we'll hit the headline numbers, the stuff that really lit the fuse. Then, and this is the real meat of the story, we're going to look at the new CEO's plan. After that, we'll circle back to the market's verdict, and to wrap it all up, I'll give you my take on what we need to be watching for next. All right, let's dive into the numbers. You got to remember, for a stock that's been just bleeding out like this one, the goal for this quarter wasn't to knock it out of the park. No way. The goal was just to stop the bleeding, to put a tourniquet on it and show investors that, hey, maybe, just maybe, we've finally hit the bottom. So here's the deal. The earnings per share, right in line with what everyone expected. No big surprise there. But the revenue, that's what got everyone's attention. They beat by more than $6 million. And yeah, core growth, from their main business, it was pretty much flat. But here's the thing, flat isn't negative. And for a market that was bracing for the absolute worst, seeing that was a massive sigh of relief. And look, the context here is absolutely everything. This wasn't some amazing report for a stock that's flying high. This was a stable report for a stock that had been completely, utterly crushed. I mean, down 54% while the S&P 500 was cruising up over 17%. That's why the reaction was so explosive. It was just pure, unadulterated relief. Okay. So those stable results, they basically just set the stage. But the real star of this show, the reason we're all talking about this, was the new CEO, Mike Nassif, and the plan he dropped on his very first earnings call. On his first call, this new guy could have tried to spin things, to sugarcoat it, but he didn't. He came right out and said it plain as day. Execution challenges are holding us back. And that kind of honesty, man, that instantly told investors two things. One, he actually understands the problem, and two, he's not afraid to call it out. That right there is how you build credibility from day one.
So what's the plan? Well, it's refreshingly simple. No fancy buzzwords, just 4 basic, fundamental things. 1, drive top-line growth. 2, get costs under control. 3, actually innovate again. And 4, deleverage, which is just a fancy way of saying pay down your debt. It's a classic back-to-basics playbook. And for investors who are on edge, it was exactly what they needed to hear.
And get this, they didn't just talk about it. To prove they were serious, they immediately announced they were cutting headcount to save $20 million a year. That's action. That shows you they're serious about getting their costs in line with their revenue, and they're starting right now. Okay, so let's recap. You've got a stable quarter, you've got a new CEO with a no-nonsense plan. So how did the market react to all this? Well, they didn't just buy the results of one single quarter. No. They bought into the entire turnaround story. And you can see just how much conviction there was by looking at the trading volume. The amount of shares changing hands basically doubled compared to the average. This tells you it wasn't just the short sellers, the people betting against the stock, getting scared and buying back their shares. This was new money, serious money, coming in and placing a bet that yes, this company has finally turned a corner. So if we put all the pieces together, why did the stock pop so hard? Well, it was kind of a perfect storm of good news. You had the revenue beat, you had the aggressive cost cutting, you had them paying down $100 million in debt, all huge. But the real kicker, the thing that sealed the deal, management reaffirmed their full-year guidance. That sent a powerful message to the market. This wasn't a fluke. This is the first step of a real plan. All right, so that's the story of what just happened. And now for the important part. What does this mean for the stock from here on out? Let's get into our take and what you really need to be watching. And this really is the million-dollar question, isn't it? The stock has had this massive rally off its lows, but let's be real, it's still nowhere near where it used to be. So, is this just a dead cat bounce before it rolls over again? Or is this the real deal, the start of a sustained recovery? Look, for this turnaround story to keep going, the next earnings call is critical. They have to deliver tangible proof. So here's what we'll be watching like a hawk. 4 key things. 1, are gross margins finally starting to recover? 2, how's that super important Petrifilm manufacturing transition going? 3, are those cost savings actually hitting the bottom line? And 4, are they still chipping away at that debt? Let me be clear, Progress on these points is absolutely non-negotiable. So, the debate from here on out is actually pretty simple. You've got the bears on one side saying, nope, the problems are too deep, this rally's going to fizzle out. But then you have the bulls. They believe this new CEO can actually execute the plan. If he does, you get what's called earnings leverage, where profits grow way, way faster than sales. And if that happens, you get a re-rating of the stock, which is just when the market decides it's willing to pay a whole lot more for this company than it was yesterday.
So where do we come down on all this? Well, here at Talk Tickers, we're initiating coverage with an outperform rating. And here's why. You've got this perfect combo of a new, credible CEO, aggressive cost-cutting that's happening right now, and management's confidence to stick with their guidance. All of that together creates what we see as a really favorable risk-reward, especially when you consider how beaten down the stock still is. Look, it's not going to be a straight line up, but for the first time in a long time with this company, there's a clear, believable path forward.
And as always, just a quick reminder, this analysis is for informational purposes only. It is definitely not financial advice.